After rising a little this week, AMC continues to remain between $30 and $35. The stock has remained in this region for over a month, and during this time there have been many that have been loading up. And while we would think that that normally means retail investors, we are seeing a lot of 13F filings that show institutional ownership increasing on this dip. Now, this isn't to suggest that the price can't go down further, but it does show that even large funds are seeing value in the stock. I suspect that we'll continue to see institutional ownership rise if the price continues to dip. And while it's not confirmation that the retail thesis is correct, it does seem to point to institutions beginning to bet on the stock going back up. Let's talk about some other trends that may impact AMC, and let's get to it. What's up YouTube, James from Thursday Media here, and in this video we're going to look at some recent trends as they apply to AMC and why history may be repeating itself. Back in April, we saw a few factors that began getting a lot of eyes and interest on AMC. Stock utilization kept inching closer to 100%, short interest began rising, days to cover became longer, and the cost to borrow AMC shares jumped. This was following the rally to $14 in March, and AMC remained below this level for weeks as the stock battled to regain the $10 mark all the way until June, when the breakout finally pushed the stock higher and then the spike to $70 occurred. Now we're beginning to see these numbers climb again. Shorts have piled on as the stock fell from the 50s and utilization has started to rise and short interest along with it. We are now seeing those steps repeating. First, the stock has been pushed down significantly from its June high, which is similar to the January spike to over $20. That was followed by an over 50% decline, like a nasty status effect that eventually wears off. And one positive status effect that never gets old is hitting the like button so that YouTube knows that we're still in the game. As we know, there was a massive amount of due diligence that came out after the $20 spike, explaining why AMC was still likely to squeeze. And during that time, close attention to things like short interest, utilization, and days to cover became the norm. The pattern is repeating, and this time with even more eyes on the stock. AMC has been featured in the news for weeks now, and if a solid run of hype continues to build around the company, we could see a third spike if conditions continue to trend the same. We're also now on the heels of an earnings report that is showing improvement in AMC's recovery. And even more promising is that the company's leadership is trying to improve their business model, using their screens for more than just movies and trying to attract audiences on otherwise slow days shows a shift in trying to bring more events to their theaters. Add on top of this the ability to pay with Bitcoin by the end of the year, and AMC is showing that they're willing to test ways to improve their business. It's no secret that movie theater demand has been on the decline in the age of streaming. But as I've mentioned in the past, AMC has a lot of real estate that can be used for more than just running movies. Another big shift to focus on this week is the reduction in margin debt market-wide. This is the first time in 15 months that we've seen a decrease in the amount of money borrowed. Bets on stocks using margin were approaching $1 trillion. The recent dip of over 4% in margin may be showing signs that the market is finally beginning to cool off. Now, borrowing may uptick again, but if banks are reeling in leverage, it's another sign that a correction may be on the horizon. This retreat from using margin is one of those key indicators that precedes a correction and has happened before. We've seen pullbacks in margin use before the 2000 crash, the 2008 crisis, and before many corrections over the last couple of decades. Now, this decline might be some rebalancing, and margin needs may continue to increase as the Federal Reserve has yet to change their monetary policies. But if we continue to see a decline in margin debt, there is a strong chance that a market correction isn't far behind. Stocks like AMC, where margin is being used to short the stock, may benefit from this if banks decide that they want to reduce how much leverage they allow. I'd expect to see stocks that have been boosted over the last year come back down to normal PE ratios, while stocks that have been heavily shorted get a bump. If you are holding other investments, this is not advice to sell so much as a warning to consider your strategy going forward. I would avoid trading on margin for much longer, especially if institutions continue to reduce their exposure. This is the pattern that generally makes retail investors the bag holders of a crash. But as always, I am not a financial advisor. I'm just a regular guy with a regular job, just hoping for a repeat spike in AMC. So always make sure that you do your own research before making any financial decision and that you make financial decisions that you're comfortable with. If you're interested in getting into the world of investing, I'll leave you some links down in the description below that'll help get you started. Some of these are even offering free stocks when you sign up and make your first deposit. If you like this video and you want more like it, make sure that you subscribe to the channel. I usually post twice a week unless I throw in a bonus. Watch for the AMC rebound, make sure that you protect your investments, and thanks so much for being here, and I'll see you in the next one.